Imagine that the most powerful companies in the world are building a machine that could transform almost every industry. They are buying chips, constructing enormous data centers, securing electricity, and spending money at a scale rarely seen outside governments. Now imagine that investors have already placed enormous bets on the companies expected to win. If artificial intelligence delivers everything being promised, this may be the beginning of one of the greatest productivity revolutions in history. But if the profits arrive too slowly or never become large enough, trillions of dollars in market value could disappear. That is why people are asking a familiar question. Are we watching the next industrial revolution or repeating the dot-com bubble of 2000? The honest answer is more interesting than either headline. AI may be revolutionary and overpriced at the same time. So today, let us separate the technology from the investment story and find out how an ordinary investor can participate without becoming the last person to buy the hype. First, a bubble does not mean that the technology is fake. It means that asset prices have risen beyond what realistic future profits are likely to justify. Think of a company expected to earn $1 a year. If investors pay $10 for it, the expectations may be modest. If they pay $100, the company must grow dramatically to justify that price. And if the market has already priced in near-perfect growth, even good results can send the stock down. The company does not have to fail. It only has to perform less brilliantly than investors expected. That distinction matters. Railways changed the world, but railway investors still lost fortunes. The internet transformed commerce and communication, but many internet stocks collapsed. A revolutionary invention can create too much excitement, attract too much capital, and produce terrible investments at inflated prices. So the correct question is not simply, will AI change the world? It almost certainly will. The better question is, how much of that future success is already included in today's prices? In the late 1990s, investors correctly understood that the internet would transform the economy. What many got wrong was the price they paid and which companies would survive. Money rushed into almost anything connected to the internet. Some businesses had promising ideas but little revenue. Others had no credible path to profit at all. Traditional measures such as earnings and cash flow began to feel old-fashioned. Attention, website visits, and ambitious forecasts became substitutes for a functioning business. The story sounded irresistible. The internet would grow, so every internet company must become valuable. But a growing industry does not guarantee that every participant will make money. Competition can destroy margins. New technology can make yesterday's leader obsolete, and a wonderful business can still be a terrible investment if the purchase price is too high. The Nasdaq peaked in March 2000. By October 2002, it had fallen roughly 77%. Numerous companies disappeared, and even some businesses that later became successful suffered enormous declines. Yet the internet itself did not fail. It became more important than the optimists imagined. The bubble was not mainly a mistake about the internet. It was a mistake about timing, competition, profits, and valuation. That is the warning for AI investors today. There are strong reasons to believe that today is not based on an empty story. AI tools already write code, analyze documents, generate media, assist customer service teams, detect patterns, and help workers complete some tasks faster. Adoption is also spreading. Federal Reserve researchers estimated that about 18% of US firms had adopted AI by the end of 2025. Stanford's 2026 AI Index reported that global corporate AI investment more than doubled during 2025. Reaching about $582 billion. This is no longer a small experiment hidden inside technology laboratories. The physical build-out is visible in semiconductor orders, data centers, power infrastructure, cooling systems, and network equipment. The Bank for International Settlements says AI-related investment has become large enough to influence economic growth, trade, and asset prices in real time. It estimates that the 5 largest hyperscalers are set to spend more than $1 trillion on AI-related capital expenditure across 2025 and 2026, and early studies often show significant productivity improvements for particular tasks. So yes, there is real technology, real demand, real infrastructure, and real revenue, but reality alone does not tell us whether the price is reasonable. Now we reach the uncomfortable side of the story. First, spending is growing faster than anyone can confidently measure the eventual return. Building AI requires expensive chips, data centers, and electricity. But somebody must eventually earn enough profit from AI services to justify all of that infrastructure. Who will pay? How much will they pay? And will competition drive the price of AI services down before investors recover the cost? Second, the stock market depends heavily on a narrow group of giant companies. In its October 2025 Financial Stability Report, the International Monetary Fund said US valuations appeared stretched. It found that the Magnificent Seven represented about one-third of the S&P 500, and that concentration risk was even higher than during the dot-com bubble. This means millions of broad index investors already have substantial AI exposure without deliberately buying an AI stock. Third, the expected productivity gains remain uncertain. AI can save time on one task without increasing the entire company's profits by the same amount. New software, cleaner data, training, and redesigned workflows may be needed before task-level improvements become economy-wide productivity. The BIS notes that individual task studies often find time savings of 20 to 50%, while estimates of aggregate productivity gains are generally much smaller. Finally, some companies are turning toward debt and private credit. A Federal Reserve governor cited an estimate that the AI build-out could require $1 trillion in new debt over 5 years. When optimism depends increasingly on borrowed money, disappointment becomes more dangerous. But calling today an exact copy of 2000 would also be misleading. Many of the companies funding the AI boom are mature global businesses with large revenues, established customers, valuable products, and in several cases, strong cash flow. That is very different from a newly listed dot-com company with no profits and little more than a website. AI adoption is measurable. Customers are already paying for cloud computing, chips, subscriptions, and AI-enabled services, and the infrastructure being built, data centers, power connections, and advanced semiconductors, has genuine economic value. The IMF has also said that estimated US market overvaluation remains more modest than during the dot-com peak. So the strongest argument is not that the entire AI economy is imaginary. It is that investors may be assuming too many winners, too much future profit, and too little competition. The dot-com era gave us both spectacular failures and businesses that eventually reshaped the world. The difficulty was identifying the durable winners and not paying a price that assumed their victory in advance. An AI correction does not require the technology to stop working. It could begin with something much less dramatic. Revenue could grow more slowly than capital spending. Businesses could decide that AI tools are useful, but not valuable enough to justify premium prices. Cheaper models could turn advanced AI into a commodity, benefiting users while reducing profit margins for providers. Electricity shortages, chip constraints, or construction delays could make the infrastructure more expensive. Interest rates could remain high, reducing the value investors place on profits expected far into the future. Or one major company could cut its AI budget, causing investors to question the spending plans of everyone else. Once the market stops rewarding spending and starts demanding returns, the mood can change quickly. The IMF estimated that a moderate correction in AI stock valuations, combined with tighter financial conditions, could reduce global output by around 0.4% relative to its baseline. That would not be the end of AI. It would be the moment when enthusiasm meets accounting. So, should an ordinary investor avoid AI completely? Not necessarily, but participation does not require betting your future on whichever stock is trending this week. Start by recognizing the exposure you already have. A broad market index fund may already own the largest chip, cloud, and software companies. Inspect a specialist fund's holdings before buying. You may simply be adding more of the same companies. Second, use a core and satellite approach. The core is a diversified, long-term portfolio. A much smaller satellite can hold higher risk ideas, including an AI theme, without allowing one story to control your future. The percentages are personal, but if the speculative part falls by half, your long-term plan should survive. Third, invest across the value chain instead of searching only for the company with AI in its name. The AI economy includes semiconductors, cloud platforms, networks, cybersecurity, power, cooling, and businesses using AI to improve products or lower costs. But picks and shovels are not automatically safe. Suppliers can become overpriced or suffer when construction slows. Fourth, ask 5 questions before buying an individual company. 1. Is AI producing revenue today, or only appearing in presentations? 2. Are revenue, margins, and free cash flow improving? 3. How much must the company spend to produce each additional dollar of AI revenue? 4. Does it have a durable advantage, such as data, distribution, customer relationships, or lower costs? And 5. What growth rate must occur to justify the current valuation? If you cannot explain why the business should earn more money, you may be speculating on somebody else becoming more optimistic. 5th, enter gradually. Regular investing can reduce the temptation to make one large purchase at the most emotional moment. Finally, avoid leverage. Do not use borrowed money, short-dated options, or emergency savings to chase a theme that can fall sharply. You do not need to predict the exact winner. You need a strategy that allows you to benefit if AI succeeds and survive if the market's expectations were too high. So, is AI a revolution or a bubble? The answer is, parts of it may be both. The technology is real, adoption is growing. The infrastructure will probably shape the economy for decades. But real technology does not guarantee sensible valuations, and a booming industry does not make every company a winner. The greatest lesson from 2000 is not never invest in new technology. It is never confuse a powerful story with a guaranteed return. Invest broadly, buy gradually, examine cash flow, control your exposure, and never let fear of missing out replace a financial plan. Because the goal is not to own the most exciting stock at the top of the boom. It is to keep building wealth, one wise decision at a time.